Hello, this is Kevin Prince from BMO Exchange Traded Funds. Thank you once again for joining us for the Market Insights webinar. Today's topic, cover calls. So I'm looking forward to diving into that topic on a basis. And we're going to talk not only about the actual strategy, but the ETFs in that strategy, because of course this session has a focus in on exchange traded funds. So as always, like to start off a little bit of disclaimer, and in this case, be clear, we're not going to provide specific advice, nor are we going to provide specific recommendations. What we're going to do is provide you insights towards the overall market. With that, let's get into it. And as you've been to these sessions before, we always like to start off with a tool to highlight the marketplace. In this case, because we're going to talk about options, we're going to have one of our guests do that. But before I do that, let me introduce some of our guests. Who's our guests today? Number one, Richard Ho from the TMX. Thank you for joining us today. And we're looking forward to seeing some of your tools in a little second. And then Chris Heeks from BMO ETFs, one of the portfolio managers on our cover call strategies. Hey, Richard, let's dive into that tool first and foremost, because we're going to talk about cover calls. You happen to have on your website, interesting tool on cover call screener. Tell us about that.
That's right, Kev. First of all, thanks for having me today. And on the TMX, actually, we do have multiple different tools to help investors. And what you see on the screen right here is our cover call screener. And basically what it does is that it screens the options market based on your desired option premium return and also potential capital gain. So the key here is really to help investors identify and find that optimal option series to use for a cover call strategies based on your expectations and also requirements. So it's a free tool, so I definitely suggest everyone to check it out. It's on the TMX website. So that's about it. So back to you, Kev.
Thanks, Richard. And you know what? Richard's right. We're going to talk about a couple of nice tools that TMX offers on their website as we go through this session today. Look forward to talking a little bit there, Richard. Hey, Chris, let's dive into this topic of cover calls. Let's start with some background and some education. Understanding of cover call. I talk about it, cover call, but what is a cover call? And give us some insights there, please.
For sure. Thanks, Kevin, and good afternoon, everybody. I think you know, a cover call is an equity-based strategy. So remember, you always start with an equity. And what the cover call strategy does is use the options market to add income to your equity. And it adds income by potentially selling a portion of potential upside. So, you know, if you can look at it on this diagram here, when you invest in equities outright, you can see you have that payoff profile of a dotted line, 45-degree angle. Stock, you know, if the stock goes up, you make money. If the stock goes down, you lose money. I think that's pretty clear. In this, so I would say is the vanilla strategy of a cover call. What you do is sell a portion of potential upside. So you say, I'm willing to give away upside on the stock above $60. And in return for selling that potential upside, you collect income. So in this plain vanilla strategy, you can see the diagram shifts. You earn income, so that shifts your whole blue line up from the dotted line. And then the trade-off is you give away a portion of, or in this case of the vanilla strategy, you give away all upside beyond the exercise price. So essentially, and we're going to get into different ways to do that because we all know clients want upside. So we'll get into different ways to modify it later, but you know, essentially that's what you're doing as a cover call investor, selling away potential upside in return for more income.
Yeah, that's a pretty clear trade-off. It's an income enhancement, but effectively there is a trade-off that you're going to sell potential upside. Let's touch base a little bit with Richard, because Richard, maybe walk us through a little bit here some of the key terminology with inside options itself.
Yeah, that was a good explanation actually on cover call strategies with Chris. Now, when investors want to do a cover call strategies, there are in fact some key elements and terms that you need to be aware of. So for instance, when it comes to option contracts, each option contract is equal to 100 shares of the underlying stock. So here, when you look at the screen, you see the security ABC. So that ABC security is the underlying stock. And as you know, option contracts, they have an expiration. So that series of April means that this is when the option contract will come to maturity, okay? Usually it will be on the third Friday of the expiration month of April. And when you talk about call options, you also have the strike price. So if the strike price is $50, that means you are selling this call option in exchange, okay, for a premium of $2.10. That is the premium return that you are going to be collecting for selling this call option. But in exchange, you are taking on the obligation to deliver the shares that you have for the strike price, which is $50. Okay, so as you can see, when you do a covered call strategy, you are looking at the maturity, you are looking at the strike price, and that brings us to the section below where we talk about the terminology. Okay, this is where we talk about the option moneyness. So what is option moneyness? Is in the money, at the money, out of the money. Okay, so these are the terms that we use for option moneyness. Let's start off with an easy one. At the money options. What is at the money options is basically when the strike price of the option is close to or near the price of the underlying stock. Okay, that's what we call at the money. Now, when we talk about in the money options, these are options where the call strike price is below the price of the stock. That's where you have intrinsic value. Okay, that's why we call them in the money. And last but not least, out of the money options, those are the call options where the stock price is below the actual price of the strike. Okay, so these call options are said to be out of the money. They have no intrinsic value. So 100% of that option premium is time value. So when investors decide to do a covered call strategy, they have to decide on the option moneyness, okay, for them to use for the strike price selection. So these are the key elements when it comes to covered call rating. Hope that helps. Back to you, Kev.
Thanks, Richard. Now, let me dive into this with a little bit more detail with Chris, because we've got some key terminology here. So let's take some of those key terminology, Chris, and let's talk about that in the components that influence those option premiums that Chris offers. That's that yield enhancement we're talking about. Talk to us about that, please.
Yeah, for sure. There's a lot of, in short, there's a lot of factors. There's 6 main factors that influence the price. The most kind of important one off the bat is the current price of the stock and the exercise price. So let's say BMO's trading at $105. If you're willing to sell the upside around over $105, you'll collect more income than if you're willing to sell the upside over $110. That's because the likelihood of the option going in the money is higher, and that's why it would be correspondingly give you more premium. If time to expiry is longer, you can also earn more. But I think one that's kind of important, and topical in terms of the current market is the volatility. So all things being equal, the volatility of the market is really a big driver. And the way that works is, let's say BMO's $100 and the strike price we'll say is $105. If BMO is acting very volatile, in a very volatile nature, it could go deep in the money, because volatility means it can go up high and it could go down low. But it's like you have that ability to go more deeply in the money. If BMO is very non-volatile, then you might say, well, it's not worth as much. So that's, I think, an important one, because one thing we've seen post-COVID, and even with a market recovery, we're still in quite a volatile market. So you look at kind of what market would suit you better to earn richer option premiums. Is the higher volatility market is going to work for you. So I think that's one that's interesting, but certainly there's a few dynamics and there's a few choices. And one of the things you do when you're in the strategy, it's a great strategy to add income, but you want to make sure you're making kind of wise choices along these dimensions.
Chris, one quick thing for you, and I was using this chart below. Richard highlighted that, for example, in his example, $2.10 was the option premium. Now you can sell that to somebody else. What happens to that value of that premium over time? And that's the chart here, for example.
Yeah, well, let's go back to the BMO example. Let's say it's at $100 and the strike is $105. Any value we would just call that time value, because the stock price is below the option strike price, so there's time value. And if BMO stays under 105, what you're going to see is that time value will erode over time. Because remember, we said if you have longer time to expiry, then that'll give you more option value. But as you get closer to expiry, that time value erodes. And the time value is really the essence of what a covered call investor is earning from the option side. And one dynamic about time to expiry is you can see it's not a linear relationship. You don't earn a certain amount of premium per unit time. You can see it's more of a parabolic curve. And a lot of that time decay you earn in the last 1 to 2 months. So that's the reason it's very common on the covered call strategies, and it's what we do at BMO as well, is really focus on those options in the kind of the 1 to 2 month time range. When you're selling options, you can take advantage of this increasing curve. You earn more time value per unit time. So you're actually better off doing 12 1-month options than 1 12-month option. You can earn more premium in that way.
Thanks for elaborating that there, Chris. Now let's talk a bit more about sources of cash flow with Inside. You talked about volatility already. Talk to maybe dive a little more in that option selection piece and the percentage written, please.
Yeah, for sure. So, in terms of the sources of cash flow, remember these are equity portfolios. So you have the same source of cash flow as in underlying equities, and predominantly that's dividend income. So if you turn to start of cash flow, it's dividend income. Then how much yield you're going to collect on the option side, really depends how you implement the strategy. And we've already started to talk about kind of different ways you can go. But essentially, the way I think about it is with covered calls, it's a trade-off. You can generate a lot of income, but the trade-off is always that you give up on upside. So, with a certain, making some of these selections, say selling in the money options, you might be able to generate 20% yield. The problem is you give up upside, and not only do you give up upside, you're actually eroding cost to doing that. You have negative upside, if you will. So, one of the keys is finding that right trade-off. And, I don't know if I'm jumping ahead, Kevin, but, I'd mentioned one thing we do at BMO very simply is we just put options on half the portfolio. And again, so if you have a market that's rallying strongly, half of a portfolio can fully participate. The one thing I don't like in that first kind of plain vanilla payoff diagram is when that payoff to the covered call strategy goes flat. I mean, as investors, we want income, but you also generally want some growth when you're investing in equities. So that's one thing we do is just cover half the portfolio. You sacrifice a bit on yield, but you get more upside exposure. Also, where you position those options in relation to the stock price is, again, going to have an impact on yield and also have an impact on capital growth. So those are, some of the key things. And, if you're doing it yourself, you want to be mindful of this trade-off, between yield and income. Or if you select a manager like ourselves, you want to understand what's their philosophy around that trade-off and how do they manage, do they think about that trade-off? How do they manage it? So those are some of the important factors you want to look at when you're thinking about this strategy.
Yeah, we'll go through that in a little more detail later on, but maybe a little quicker. Hey, quickly too, on top of that is the dividend aspect too, because of course you're still earning dividends by writing this strategy on the stock. So talk to us about why it's important to have the dividend aspect of the security too.
Well, this is one of my favorite charts, Kevin, and it just shows you how powerful dividend investing is in the Canadian equity market. And, like any portfolio, the portfolio is like a house, and a house is, you want to have a strong foundation. And the analogy to cover calls is, what is your underlying equity portfolio? And one thing we notice in the Canadian market, and it's true across all markets, it's particularly true in Canadian markets, investing in a dividend-based strategy tends to give you better trade-off between return and risk. So if you look at this chart here, dividend growers and dividend payers have delivered more return than the index. Non-dividend paying stocks, that's not actually an empty data point. They actually deliver on average a 0% return over the sample. So we're not missing a bar there. That return is actually 0 for non-dividend paying stocks. So you get more return, And then on the other side of the chart, on the right side, you can see the volatility, standard deviation of returns as a measure of risk. And it's lower again in the dividend growers, and the non-dividend payers are the highest risk, most speculative stocks. So, one thing we believe in is you want to have a strong portfolio as your base. And not all of ours are dividend focused. We have, some, we launched recently a technology sector that's a little bit different, but I mean, in general, most of our products, Kevin, they're dividend based, and it's a really effective way to look at, building that foundation of equities of your portfolio.
Yeah, thanks for that, Chris. And I mean, this is the key thing for anybody looking to even do option strategy or own securities, is having that dividend base, because that's the core part of your income, and then the enrichment coming from the option overlay on top of it. Chris, quick example here, and then we'll go through some of how the strategy works in different markets, but walk us through a quick example here on BCE and how the cover call overlay on top of it change the dynamics of that path a bit.
Yeah, for sure. And this is just a really illustrative example on one stock. But when you go into a cover call strategy, there's really kind of three things that can happen with a stock. You can have a strong rise.
Here, I'll just put it up there.
Yeah. So you could have a strong rise, and maybe we can just go back to the visual, Kevin. I think the visual will help kind of show it, and then we've got some more material. But you can have that strong rise. You can have stock going sideways or the stock going down. So remember, let's start with those second two scenarios. When the stock is going sideways and you're selling an out of the money call option or even an at the money call option, you collect that call premium and there's no negative impact. You don't give away any. Remember, you sold away potential upside. So if there's no upside or if there's very small upside, you keep that. So that's what you can see in the second half of this chart, where BCE, Bell Canada goes sideways. And then towards the end of the chart, it's going negative. You can see the cover call is outperforming because you're adding to income. So your return on the strategy is the equity return, but you're buffered by the option income. Now, in what scenario does cover calls underperform? Strong equity rallies. So you can see at the beginning of this chart, BCE rallied, call it 7.5% in about 2 months. And the cover call strategy lags somewhat. So remember, you're selling away potential upside. Kevin, if you want to go to the next slide now, maybe it's in those rising markets where you can, lag somewhat. And then again, you can make up room when markets are moving sideways and downwards. And again, I would say this all, I'm speaking somewhat generically, but it also very much depends on, we go back to some of those choices we talked about, are going to determine how much you participate in a rising market or how much income you generate in a down market. So again, just to go back our strategy as an example, when you're covering 50% of your portfolio with options, remember 50% fully participate. So that's when you talk about managing that trade-off between upside and income, some of those choices are going to impact that as well. So, but those are generally how you would expect a cover call strategy to perform.
Yeah, I mean, it's kind of key for people to understand, because there's always a risk and return and there's a trade-off here. And then down markets, of course, you can probably participate a little outperformance. Rising markets, probably a little bit underperformance. And of course, in that sideways market, maybe a little bit outperformance there across the board. So key to think about that when you're implementing these strategies, whether in an individual security basis or through an ETF provider out there. Hey, Chris, let's flip gears a little bit here. Oh, before I do that, Richard, we talked a bit about securities here. We talked about cover call strategies. I know you've got a great tool. Talk to us about the tool to help somebody educate themselves on that.
Sure thing, Kev. And this is the second options tool that the Montreal Exchange has. It's called Options Play Canada. So in a nutshell, what Option Play does, amongst other stuff, is that it helps you identify call options that you can write against your stock position based on analytics and also your market outlook. In a nutshell, what it really does, it helps you create a watch list. It gives you, at the end of the day, like bullish and bearish trade signals. And based on those trade signals, Options Play will create a technical score. So from that technical score, investors can either follow the identified market trend, Or you can even use a contrarian play where you can say, look, I see the technical score is very high, it's a bullish trend, but instead of going bullish on it, I think it's bearish. So what users can do is that they can click on I'm bearish, and options play is going to give you, if you're bearish, you can short the stock, buy a put, or do a put spread. Or the inverse is also true. If you are bullish, you can buy the stock, buy a call option, or do a call spread. So options play really what it does is that it gives you like you can see firsthand what your maximum risk and potential return is before you put on the trade. And also the other thing that I want the audience to see is that on this screenshot, we're looking at the Bank of Montreal shares. As you can see, the stock itself is paying out a 4% dividend yield. Now, on the right-hand panel, do you see the income button? That's where you can say, look, I want to generate additional income on my BMO shares position holding. So what I can do is that I can do a cover call strategy. It's going to ask you how many shares of BMO do you have in your account. If you have 500 shares, it's going to ask you next, what's your cost basis? If your cost basis here is $98, options play is going to say that, okay, if you have 500 shares, what you can do is sell 5 call options on your BMO shares. So on top of the 4% dividend yield, if you are able to capture that option premium yield of here in this case is about 0.42%. If you annualize that and you add the 4% dividend yield, if you get to do this on a 12-month basis, you get a potential or projected yield of 10.45% return. So this cover call strategy is really powerful. And this options play tool is going to help you easily identify those trades without going through the entire option chain and so on. So to get a free Options Play Canada account, you can go to the link that you see on the screen, and it's a free tool offered to you by the Montreal Exchange. Back to you, Kev.
Thanks, Richard. Really appreciate you showing up today and, of course, highlighting some of the core tools for the investors out there. Hey, Chris, let's flip gears a little bit here with you. And I know you've been itching to talk about some of the cover call ETFs out there. No problem. Let's dive into those more now. So we're shifting from the equity, from the actual individual equities now into cover call ETFs for that matter. Now, Chris, why would somebody look at cover call ETFs to implement a cover call strategy? And just give us a few examples here, please.
Well, yeah, thanks, Kevin. I mean, these are a little more on the sophisticated side when you're dealing with derivatives and options. So, that's one thing we try and do is leverage our expertise. In our case, we've been running these strategies for 10 years. We've built our team around these as they've become very important for our clients to earn income. So certainly professional management is a reason, in our case, we'll be, on option expiries, it's not uncommon for us to have in excess of 200 positions at any given time, having 400 option positions. There is a little more monitoring required. And so, as a result, what we find, or what I find personally is, a lot of investors and advisors and do-it-yourself investors really like the strategy for its ability to add income and still give you some participation in equity growth. But there's a little more legwork, I think is to be fair. So I certainly don't discourage anyone from trying to take it on themselves. But, the advantage of the ETF is we can give you, the exposure all in kind of one easy, easy ticket, so to speak, one-stop shop, or kind of like a one package solution that can get exposure to all of these things. So I think that's the key thing. And certainly, on the ETFs, whether it's cover calls or any ETFs, cost efficiency, Kevin, is something that's so important to us. And, having reasonable prices for our products that we can, add the value for investors, whether it's in cover calls or elsewhere.
Can't agree more. And quickly highlight the last point too. The other thing I love about cover call ETFs is they allowed investors to access this strategy too, because going back to what Richard said, maybe you don't have 100 shares of the underlying. You know what? You can now implement this strategy for any account size you have out there across the board. Hey, Chris, let's dive into the cover call strategies a bit more, because you talked a bit about initially about percentages. And there's a different style of various cover calls out there because, of course, we have them. There's other ETF providers have them. We'll get into that in a bit. And they all tend to have a little different style. So helping the investor here understand what that style is and why that means, why that is a consideration. So let's first talk about the first style, which is basically your traditional style of cover calls. Talk to us about that.
Yeah, so this is the kind of quote unquote plain vanilla approach. You sell away all of the upside beyond a certain point. The benefit is you earn a lot of income. We did see this in the Canadian marketplace in the earlier days of these strategies, but I think the problem here is somewhat obvious in the picture, in that, again, when you're investing in equities, you want to have upside. You understand you might not have full upside in a cover call, but you want some upside. You don't want to give up returns, especially when markets have been overall very, very strong. So yeah, we did see some of these type of strategies early on. The problem is they just don't deliver the upside exposure for investors. So as a result, we don't see this. Yeah, we don't see it too much anymore.
Good for income, not for market participation.
Yeah.
Then, of course, another strategy we see sometimes about 25%, so a little piece of it. And talk to us about that quickly there too, Chris.
Yeah, so we do see some ETF providers utilizing a strategy more like this. Again, one of the benefits is you can see you have upside participation, and that's something you want to have. One problem with, one thing that's a little different, when you only cover 25% of a strategy, in order to earn a meaningful amount of income for the client, typically what you're going to have to do is those options are going to have to be closer to the money. So here, we've modeled a strategy of at the money option. So if BMO's at 100, we're going to sell a call at 100. And for 25% of our portfolio, we're going to forego that full upside. So this is a strategy we see somewhat, it's an improvement over the prior one, but does still have that challenge of selling at the money options, which can be a concern.
Thanks, Chris. And of course, the last one you're quite more familiar with, 50% written.
Yeah, and not just 50% written, but also using the out of the money options. So in this example, if BMO's at 100, we're not selling that $100 strike. We're going to call it a 105 strike. Again, all cover call strategies, you tend to see them do it over a 1 month or 2 month time to expiry. But the benefit there is, let's say it's a 1 month option, BMO can go from 100 to 105 without any negative impact, right? So not only do you have upside participation because half the portfolio fully participates in the rally, but even on the portion where you do have options, you can see better upside participation because a lot of times the market just kind of chugs away, goes up 1% or 2%, 3% a month. And in this type of strategy, using out of the money options, you can add potentially more value, and and that's something we see, that actually out of the money options can deliver a very attractive return profile, and can be an intelligent way to do it.
Yeah, balance of income
in line with our methodology.
Thanks for that, Chris. I like the balance of income and growth. Now, just for the providers out there, just a quick little snapshot. TD Securities did this insight for us in the marketplace, and I grabbed it for this particular presentation. What I'm really highlighting here is the various ETF providers in Canada that offer cover call strategies, and more importantly, going back to what Chris talked about, is the coverage ratio where it's known or where it's locked down across the board. So you're seeing various different styles again of the ratios in which the derivatives are implemented, and that may give you more insight to the trade-off of the yield you're earning versus the market participation you'd be getting. And it's always about a trade-off. And also quickly highlight BMO ETFs. We've been in the marketplace as the initial cover call provider here in Canada. Actually, we're about 75% of the Canadian market right now. So thank you for everybody who's taken the time and effort to take a look at our product line out there. And if you want to visit our website, bmoetfs.com, lots of information out there. And as Chris mentioned a little bit on, there's a brand new ETF out there too in cover call strategy, ZWT. It's a technology-based one in addition to our lineup out there across the board. Richard, let me close off with you quickly. Last tool you have here, you have a trading simulator. Give me a quick little insight of that one.
That's right, Kevin. We have so many trading tools to help investors, self-directed investors, learn about the different strategies, listen to these fantastic webinars like you're hosting on a weekly basis so like that they can strategize. And best of all, they can trade. They can trade in a risk-free environment without, using actual money at the get-go. So they can create or set up a trading simulator account, go to the MX website here that you see on the screen. So like that, you can trade any Canadian stock, ETF, and option strategy out there. So these are the tools that the exchange offers. So I hope that the audience here listening in will leverage these tools and use them to go through their learning journey. So back to you, Kev.
Thanks again, Richard. Thanks for joining us today and sharing the tools from the Montreal Exchange. Very good place to start learning about options.
My pleasure.
And of course, implementation of them. Hey, Chris, we're gonna have a little bit of time here to dive into some questions. So let's jump into a few of them. I'm gonna make you work a little hard here. Let's see how fast we get through a number of them.
Sounds
First
good.
and foremost, ZPay, popular ETF out there. Thank you for those people who look at that one too. Really what they're looking at here is how does it work? And how you earn this percentage, is it or income, and what's the trade-off behind that one? So if you can give us a quick little insight there, and thank you for the quick note on hosting these events. Appreciate that, Tone.
Yeah, ZPay, or the BMO Premium Yield ETF, it's really a combination of a covered call and a put right. A put right is a very similar strategy. And so it's partially equity and it's partially puts. And what you essentially see is that equity can move from, say, 25% to 75% in the portfolio. You're always generating yield in BMO Premium Yield in the solution. So you're always generating, on a monthly basis, we're always generating that, we're paying out a 6% annualized distribution, about maybe 6.5 right now. We're always generating yield. Certainly that's the primary focus. We do also have the ability to buy low and sell high, and it's maybe it deserves maybe a little more than a quick sound bite, but we can use the options to enter stocks at lower prices and use the covered calls to exit stocks at higher prices. And what we've done with this fund is, given the market rally has been so strong, we're more at that what we would consider the high end of the range, but we're still selling puts. And what will happen in this strategy is, if the market sells off, we'll end up buying some more equity exposure, and all the while continuing to earn yield. But we will be able to add more capital return if, say, markets sell off. We'll buy in cheaper, and then as markets generally would recover over time, we'll be earning a capital return as well. So primarily income, but we expect to earn some capital return as well. And we did last year, as we bought into equities kind of in March, April, when the markets were quite low, we bought into equities, but then as the market rallied, we sold those equities as the market went up. So it's got a little buy low, sell high approach as well for some capital return in addition to the income.
Thanks, Chris. I'm gonna keep you in the hot seat here.
Okay.
Tech stocks got a little hit this week, right? Interesting, they looked at one of our newer ETF, ZINN, and looking at relative to the ARK ETFs out there, it fared a little bit better. So can you give us some background on why this one fared a little bit better, considering they're actually basically using the same universe of securities?
Yeah, so both of them are involved in what we would call thematic technology investing. ZIN is the new product from BMO, the BMO MSCI Innovation ETF, and ARK has a very similar ETF as well. It's listed in the US market, has been one of the bigger successes in the overall ETF space in the last, call it 12 to 18 months. So both are very much in a similar themed of industry, which is kind of innovative tech exposure. That innovative tech has certainly been a market leader the past couple of years, but we have seen that there's been some, price consolidation. It's a theme we very much believe in for the long term, but there's price consolidation, and given some of those moves, it's probably not surprising to see some price consolidation. I think the greater trend and secular theme of tech is still intact. Now, in kind of like, handicapping how one looks versus the other, one thing about ARK, one reason it became so successful is they're a concentrated, actively managed portfolio. They had very high weights on Tesla, very high weights on Roku, And, you know, I wouldn't say they hit the jackpot because I think there was some skill with their stock picks, but they certainly, everything worked in their favor kind of coming into this year. And, you know, the problem is, you know, that concentration in portfolios can work for and against you. And what you've seen the last 2 weeks is that can work against you. So when we offer the product, you know, I think our DNA is a little more diversified, spread out. We tilt back to the market cap. We've got a security cap of 5%, so the maximum security weight would be 5%. In the ARK, it's 10. So right there, holding Tesla at a 10% weight over a 5%, you know, ours is, I believe, actually under 5 in Zin. You know, that was a big detractor for ARK funds. So in terms of the methodology, you know, again, we've done something that I think fits our DNA as an ETF provider very well. That's diversified, reduces volatility. I always say there's nothing wrong with a concentrated fund, but you have to realize as an investor, you know, a concentrated, actively managed fund like the ARK, it's going to likely bring along, you know, an associated increase in risk. So yeah, similar funds on similar themes, but you've seen more volatility in the ARK predominantly because it's concentrated and you know, less diversified, more of a concentrated portfolio.
Good point, Chris. And I highlight to the investors listening, you can go to our website, see all the holdings inside there, which is what Chris is really talking about, as well as I'll give a shout out for ARK because they, of course, put all their holdings on their website too. So definitely a good way to take a look at that. And that's really the attribution here we're talking about, is the holding differences. Chris, here, a little more complicated question. Really taking a look at percentages written for a portfolio. You talked about that already, but I think I want to talk about the second question here is, you know, if your call goes in the money, because you sold the call, it's now in the money, what do you tend to do in the approach here? What do you let it exercise, or what happens there?
Yeah, for sure. Well, you know, these are they're equity strategies at their heart. So say, for example, a covered call banks. We want exposure to the 6 Canadian banks. It doesn't go away just because a call option went in the money. We systematically want exposure to those banks over time. So what we do in our strategies is we tend to roll those options, which essentially means close out the option that's expiring and put on a new one. And so as it's phrased in the question, up and out, if it's in the money, that's exactly what we're doing. So we tend to use the option market to close out and put on new positions. And of course, we always have to make sure the trading makes sense, but generally it's a very, you know, effective way to do that. So that's what we look to do. You know, the downside is if you let the option finish in the money, then, you know, as a fund, you have to deliver your stock. And if you want to hold that stock, that means you have to go back in the market the next week and buy it back. So our preference is just to maintain the stock. And for that reason, we generally seek to close out those options and put on new ones and hold on to our stock.
Thanks for that, Chris. And I think that's all we have time today to go to questions. And I'm really thanking everybody for taking the time to ask questions. Some of the questions we got in this week in regards towards taxes, good news, because you know what we're going to do next week? Next week on Friday, March 12th at 1 o'clock, we're going to dive into taxes and specifically around exchange traded funds. You know, kind of give you some insights as you get prepared for the upcoming tax season across the board. So hopefully you can take the time. Join us next week on March 12th as we dive into taxes around exchange traded funds. Thank you. Have a great week ahead. Cheers.